Hello, and a warm welcome to Views from the Top. I'm Hansley of Livewire Markets, and thanks very much for joining us. Our guest today is Warryn Robertson, Portfolio Manager and Analyst on the Global Listed Infrastructure team at Lazard Asset Management. Warren's going to share some of what he's seeing in his asset class and give some perspective as well on how big macro trends like the return of Donald Trump and the rush of inflows into unlisted infrastructure are affecting his opportunity set. Hey Warryn, welcome. Good to have you with us.
Great to be here.
Warryn, it's still early in the year, and we are still digesting outlook statements, I think, but when you look at the year ahead, what's the most important insight that infrastructure investors should be thinking about over the next 12, 24 months?
Sure. Look, I think as 2025 is now upon us, I think the key things for investors to look at is when you consider infrastructure within your client mix in terms of the assets that you'll allocate, the ones that you want to allocate to are those assets that have certain characteristics that are attractive. What people think about with infrastructure, it's that revenue certainty, the ability to translate quite predictable revenues into profits, distributions and dividends that just go along with the general economy, if you like, and then the ability to do this in an active way.
I think about the current macro environment that we're in. It's obviously incredibly volatile at the moment. Bond yields have been surging, interest rates will likely be higher for longer. So with that in mind, why should investors still consider infrastructure investing with that backdrop in mind?
Sure, and a lot of people think of infrastructure as a bond proxy. And in some ways you could argue at its very simple level, it is, but there are nuances within that. There are assets that operate like nominal bonds. So a lot of the US utilities will operate in a similar way to a nominal bond. They have a fixed coupon, and as interest rates rise and fall, they live off that. But most infrastructure is like an inflation-linked bond outside the United States. So a lot of European names that we favour, Australian names, have that inflation-linked component to the revenue and contracted earning streams that they have. So understanding that is the first nuance. Infrastructure works irrespective of what the macro backdrop provides because of the inherent nature of the assets that there are. So if you're thinking of higher for longer interest rates, that would typically mean that GDP growth is going to be stronger, and these assets are the way we facilitate domestic production. It's how we go about our daily lives. So toll roads will see more traffic. Railroads will take more cargoes. Planes will land at airports more often, and the utilities will foster stronger electricity demand and gas demand growth if the economy is growing faster. In our valuations, we've always assumed higher interest rates than what the prevailing market is for a number of years now. We've always looked with that lens, and so our objective is based around that macro environment, and that's what gives us the opportunity today when the market becomes, is the Fed going to drop faster than the ECB or the Japanese central bank? People make these sort of weird calls. We're looking through that to what is the underlying earnings of the business with a very conservative macro backdrop.
You've been doing this a long time, if you don't mind me saying. How long have you been in markets?
About 30 odd years now.
All right. In that time, obviously you've seen a lot of markets come and go, a lot of bull and bear markets come and go. How does today's opportunity stack up to other times in your career?
In terms of absolute returns that we're seeing from our portfolio, and again, if you look at the broader universe, there's attractively priced stocks and unattractively priced stocks. So if we look at the portfolio, which we think is concentrated on those names that we do think is trading well below intrinsic value, it's certainly not as cheap as 2009, global financial crisis. Everyone thought every infrastructure stock was going to go bankrupt, which certainly was not the case. Mm-hmm. The ones that we owned had no issues with their debt and they sailed through, but the market, the sentiment had gone out. Certainly not as cheap as March 2000, when everyone was buying eyeballs and anything to do with the internet and boring old utilities and infrastructure names were left behind. But in terms of relative positioning, where infrastructure sits relative to broader equities, aside from those two periods in 30 years, this is probably one of the most attractive.
Let's move to the macro in that case. There is the return of a certain person in the White House to contend with, Donald Trump. Trump has threatened to impose 25% tariffs on Canada and Mexico. He says he will execute 10% tariffs on China. This situation is so fluid it could change at any moment and based on any tweet. But more broadly than that, of course, he's also pledged to rescind the unspent funds of the Inflation Reduction Act. That affects green energy and infrastructure investments. So I guess how does his return to the White House impact your investment decisions, and what's different about this time compared to 4 years ago?
You're right, it is a fluid situation. It's about as fluid as his Sharpie pen that keeps signing all those edicts. But I think at this stage, the unintended consequences of a lot of this need to work their way through. You know, the globalization dividend that many companies have been able to have over the last couple of decades, maybe that's starting to wane, and we're seeing, and that actually did start during the COVID pandemic when countries realized they had to insource back some of those productive capacity. And that is good for domestically based infrastructure because more railroads, more railway carriages are needed, more trucks are needed to move stuff around, more planes are needed to move your goods around. So that is a good story in terms of that domestic positioning. The other day I was reading a third of the nuclear fleet in terms of power generation in the United States sources their uranium from Canada. Now that then would feed through to higher electricity prices for customers, and there are going to be winners and losers in that in terms of the utilities in the US. Companies that we look at, fully regulated utilities, pass that through to their consumer. So the consumer ends up losing in that regard. If you're an independent power producer, a merchant power generator, stocks that we don't consider for investment, they have to wear that additional cost. It's unlikely they'll be able to pass that through. So understanding and working through that is going to be a difficult dynamic. But one thing that is certainly the case is that we think inflation risk is going to be higher for longer. We think you will see it's more likely scenario that 3 to 4% is going to be the inflation band over the medium term globally than less than 2%, which is what we've enjoyed for many, many years. And just thinking how that works through revenue lines, cost lines, cash flow for companies is critically important to picking the ones that you think will be able to navigate this new Trump world.
Of course, infrastructure is not just about the stocks, it's also about the assets. There has been a flood of money into listed and unlisted alternative assets like infrastructure, especially since that massive drawdown in 2022, and we all realized that a portfolio only made of stocks and bonds doesn't quite cut the mustard. How does this rush in flows actually affect your opportunity set?
The private equity guys will tend to have a similar lens to us in terms of the types of infrastructure assets that they want to own. That definition gets blurred because, as you say, there's a wall of money and they only get paid when they put it to work. So they'll start to sort of blur the definition of infrastructure, inviting some potentially new types of assets that they want to invest in. But we have been a happy hunting ground for the private equity guys over time, and they have paid a premium. So if you look at comparable assets around the globe, the rule of thumb is that private equity, sovereign wealth funds, direct buyers will pay 20 to 25% premiums to own a similar asset that the listed market that it trades on. So not only are you getting the takeover premium, but they tend to pay just more generally for these types of assets. Now, we've been the beneficiary of that. In the time of 20 years that we've been running listed infrastructure, we've only ever considered for investment 200 stocks.
Yeah.
Of those 200 stocks we've only ever considered in totality, 25 of them have been subject to takeover. That's an incredibly high hit rate, and it comes down to those investment characteristics that we favour are the same ones that the sovereign wealth funds, the private equity funds, the direct infrastructure players want when they buy infrastructure. And if they're prepared to pay a premium and accept lower returns in the long run, then we're happy to feed the ducks when they're quacking.
And they have come quacking, especially in the last couple of years. You mentioned stocks. Let's go there. If you had to nominate, and I realize I'm putting you on the spot a little bit here, but if you had to nominate just one name, what would you say is the highest quality infrastructure stock in the world?
Think of the one infrastructure name that you would want to own. It's Ferrovial. 80% of the assets are in North American toll roads, and these are some of the greatest assets that the world has ever given to private investors, because essentially you own multi-decade concessions in congested corridors where people are desperate to get from A to B in certain times, and these toll roads provide that congestion relief.
And just for the benefit of our audience, where is Ferrovial listed?
Ferrovial's listed in Spain. It's just set its secondary listing in the United States on the New York Stock Exchange, on NASDAQ, I should say. But 80% of its assets are these fantastic US and Canadian toll roads. And what makes them so special is there is basically no limit to what they can charge people. Right. Now, let that roll over you. When you have a multi-decade monopoly asset that you can charge whatever you like to whoever uses that asset, it creates incredible pricing power and incredible cash flow generation that we are probably being too conservative about what we think the business will earn.
And a point for the Spaniards. Similarly, I've asked you to name the highest quality infrastructure stock in the world. What would you say is the highest quality infrastructure stock in Australia? And I'm fully aware that the amount of options there are
have dwindled
continue to decrease by the year.
Absolutely right. Look, within the very small bag of stocks that are left, Transurban is the highest quality name that you could buy. And when you compare it to Ferrovial, the concession lengths are slightly shorter. So Ferrovial has longer lengths and it has pricing that's capped. Now, it's attractively capped. They have inflation or better on the vast majority of their toll roads, but it is still capped, unlike Ferrovial, which can be, charge what it likes to whoever comes. In terms of the more attractive name, though, on the Australian market, we would put Atlas Altiria, a slightly better valuation perspective, slightly trading at a bigger discount to intrinsic value. But if you had to say quality, Transurban wins. But in terms of value proposition, Atlas Altiria.
Got it. Ferrovial, you talked to a little bit just then. Obviously, they've got their massive business in toll roads. I'm glad you brought this up because I did notice that nearly 50% of your portfolio is in diversified utilities and toll roads. So I was wondering if we could kind of delve a little deeper into that. Why are these two sectors such compelling investing?
Yeah, I mean, and it comes down to our definition of infrastructure. So, half of our investable universe are US utilities. We are cautious around that as a sector. Yep. We think as a sector, it's still probably 30 to 35% expensive, largely because they've taken their balance sheets and geared up appreciably over the last 2 decades. And the market's fixated on PEs and not thinking about the whole capital structure. And so that's where we're cautious, although there are some good opportunities within US utilities, half of our universe, significantly less than half of our portfolio. As you say, we're much more favoured towards UK and European utilities, largely because of the regulatory regimes and the way that they operate is slightly different from US utilities, who are essentially do all things. They generate electricity, they transmit it on the big power lines or the big gas transmission lines, they distribute it to people's homes, and then they organise the billing. So they're the entire value chain. In Europe, that value chain is broken up, and so the monopoly transmission assets, which are the ones we really like, small component of the bill, absolute monopoly status, and great growth opportunities. If you take National Grid, which is one of our favoured stocks, this is a 60-year-old business, which over the next 10 years is likely to grow its UK business by about 50%. And what it's doing is it's facilitating the energy transition. It is linking to its existing network the renewable solar wind farms to its existing network. So those power plants will make money, not make money when the sun shines or the wind blows. National Grid makes money regardless because it gets to charge, it gets to include that capital spend into its RAB, and that is a guaranteed return. Now, so this stock, 60 years old, growing its asset base by 50% over the next decade, with leverage that's 60, 70% increase in the equity base, and the risk around doing that is pretty darn low, pretty close to zero. And what am I paying for it? Some of the lowest multiples it's traded on in 2 decades. What you're paying for what you're getting makes National Grid, one of the most attractive names we can own today. And that's why it's a big position in the portfolio and makes it one of those diversified utilities that you spoke about.
Okay, excellent. You've been mentioning a lot of global stocks, so I really wanted to ask this as a follow-up. We have seen a huge surge in the US dollar against all currencies in recent months. How do you think about hedging your returns in this climate?
We have, as a rule, always hedged the strategy. One of the reasons for that is essentially as an investor who is going to be looking at taking inflation-linked revenue streams and earning streams, if you hedge the currency, because of the inflation differential drives those hedging rates, you're essentially importing UK inflation protection or Spanish inflation protection or US inflation protection back to an Australian investor. So from a theoretical construct, that's how you get the inflation pass-through. Me sitting in Australia, investing globally. The other thing it does is it reduces the volatility of our returns. Over the long run, we've produced higher returns than listed equities. We've done it with lower levels of risk, and our standard deviation of returns has been reduced by hedging that currency volatility. And it also enables us to take much more active positions. We don't have to worry about how we sit relative to an index if you're hedging the currency, because the dollar movements are not moving different from the index to your portfolio. You've taken that risk out. So as a rule, we've always hedged.
Let's wrap this up, sir. I mentioned at the beginning that this series is called Views from the Top, and it's time for that titular question. So, what is one thing you have become privy to that you wouldn't have realised or had access to if it weren't for the position that you are in today? Warryn Robertson, what is your view from the top?
I think if you had to distill it down to one thing, is that great companies and great businesses attract great management. And poor companies that operate in difficult investment environments attract relatively poorer management. You don't see great managers go to difficult businesses. Some might try, but it's always easier to shine in a great business. And that, I think, is part of the rationale behind wanting to invest in great businesses, because good management are attracted to them, and what they'll do is that they will be able to grow that business much faster, invest well, and generate better returns. So, stick with good companies, have a definition around what you mean by that, and understanding, for us, it's predictability of earnings. That's the key component, and that attracts better management, and we think over the long run, that serves you well.
Good businesses attract good people, and you have been very good to join us. Thank you very much there. That's Warryn Robertson of Lazard Asset Management. Thanks, Warryn.
Thanks very much.
And thank you for joining us. If you enjoyed that interview, you can subscribe to the Livewire Markets website, as well as our YouTube channel, where you can find more views from the top. Until we see you next, thanks for watching.